was incorporated in 1968. It's an API and CDMO segment is what it focuses on as well. And obviously, in terms of the IPO size, that's an 840 crore IPO, which is open today for subscription. To talk more about the company going forward, what we should be expecting, we're joined by Mr. Shiven Arora, Managing Director, and K Singh, the CEO at BlueJet Healthcare this afternoon. Thank you so much, gentlemen, for joining in with us this afternoon on ET Now. Shiven, I'm going to start with you. And when you look at it in terms of the IPO, obviously this is a complete OFS that is there. So, what is the reason for paring the stake here? And if you could help our viewers understand that why, are we looking at this OFS right now for the IPO?
Firstly, thanks for having us. So it's a 50-year-old legacy business for us, right? And the segments that we operate in have been really under the radar, highly niche, underpenetrated. The revenue CAGR since FY21 has been 20%, but if you go back a few more years, the CAGR growth is much more positive. So to maintain this high growth and traction, we need to gain visibility in the market. And today the dilution is just 14%. Balanced dilution would be done in 36 months to reach 25% as per the guidelines. Company is debt-free, good abilities in capital management. ROCE numbers are north of 30%. Asset turns have historically been 5.6x. So we have good abilities in capital management. We will fund the CAPEX completely through internal accruals this particular CAPEX cycle.
Okay, so point taken. You're talking about growth, but let me bring Mr. Singh also into the conversation. While the growth, of course, the CAGR has been quite impressive, the margins have depleted if you look at the last few years. From 42% in FY21, it's down to 33%. Do you think going forward, this is the range we should expect from the company, 30 to 35%? Or do you see more levers for improvement on the margin front?
See, historically, you will see that we have a track record for very high profitability. Our margins did reduce, and that was to some extent because of the global phenomenon that the basic chemical prices were increasing. And since we are a chemical intensive company, there was a dilution of margins. The freights were also increasing, and that also was another factor that caused some dilution of the margins. As Shiven mentioned, we are adding capacity. We are also ramping up our R&D capabilities and manpower. So the employee cost also went up. Because of all this, the margins were slightly less. But I guess if you would see the Q1, because of the softening of prices of chemicals and because of the softening of freights, which are now normalizing, our margins are getting back to the level at which they used to be. So I guess going forward, I think the going will be good.
Right. Mr. Singh, just a continuation in terms of the margins as well. If you could help us, just give us a breakup in terms of the margin profile. We do have the revenue mix coming in from your segment, but how is the margin breakup coming in for these three segments as well? And, how do you see the margins panning out specifically for each segment then?
See, we don't do a segment-wise P&L, but then overall, you will see the gross margins of the company. The blended gross margins are around 56, 57%. And I would say that all the three segments that we have, they're in the same band, give or take.
Point taken, Shiven. What about at least the revenue from the three segments? That's something that you have disclosed. Going forward, which vertical do you think will see the maximum amount of growth? What's the focus area? Which are the high growth markets per se?
See, contrast media as a segment for us is about 70% of the business. And it's majorly innovator-led, backed by multi-year supply agreements. And we see good traction in this particular space because this is for the medtech industry. And the overall diagnostic industries where it is used for, so CT scans and MRIs, has seen a good growth in terms of the overall traction of the supply of medical devices, which is really propelling the growth, not only in the developed healthcare economies, but also in the emerging markets. So this could be a dominant segment for us even going forward. The other vertical, pharma intermediates, which is about 5% of our business today, is also towards innovators in chronic therapies such as oncology, CNS, and cardio health. Some of the candidates that we were tracking has gained marketing authorizations, and we hope the clinical data supporting it is also positive. So there could be some traction around this segment as well.
Right, and Shiven, lastly, if you could just talk to us in terms of your expansion plans for the company going forward, planning to add any new capacities, and also the second point I would want to know in terms of your global domestic focus as well. Obviously, global currently accounts to 85% of the business. How is that shaping up? Should we expect more focus, or global is going to be continuing to be the key focus area for the company?
Global would be the key focus because specifically in contrast media and pharma intermediates, the global innovators that we supply to have their manufacturing hubs concentrated in these geographies. But having said that, CAPEX cycle, we are in the middle of a very strong CAPEX cycle. Since 2018 till 22, we were able to quadruple the capacity that we have from 230 KL to 1000 KL. And in the next 24 months, we'll be adding another 50% to our reactor capacity, completely through internal accruals. We are a debt-free company.
Okay, point taken. So debt-free company looking at expanding your presence, and of course export is going to be the focus area given large part of the client list comes from that. Thank you, gentlemen, for joining us, and all the best for your IPO. Of course, the subscription figures so far have been quite supportive. Let's see how that issue closes as well. But in the meantime,